Hey everyone, and welcome back to the Web3 Daily. The market's been giving off some really mixed signals lately. On one hand, we're seeing these positive macroeconomic signs, like the dovish comments from the Federal Reserve, which seem to be giving the crypto market a shot of adrenaline. A lot of institutional money is starting to move, which is a good thing. But on the other hand, the overall market, especially Bitcoin, is stuck in this sideways trading range. It's like the market is holding its breath, waiting for a definitive direction. Let's look at the core assets first. Bitcoin's price has been bouncing between 111.0 and 113.0. It hasn't managed to break through K resistance, but it's also held on to that crucial support level. What I found interesting though, is the on-chain data. For the first time in 10 days, we saw a net outflow of Bitcoin from exchanges. This suggests that investors, at least on-chain, are leaning towards long-term holding rather than short-term selling, which is a really positive sign for market sentiment. In contrast, Ethereum's performance has been, frankly, surprising. Instead of following Bitcoin's sideways trend, it's showing incredible resilience and even hit a new all-time high of 4,955. Have you guys noticed the massive inflows into Ethereum spot ETFs? We're talking over 1.3 billion in just the last week. This follows a period where ETF inflows surpassed Bitcoin ETF inflows for the first time. I think the narrative for Ethereum is really shifting for institutional investors. They're starting to see Ethereum's true value as programmable money, not just a hedge like Bitcoin, which we've been calling digital gold. And in the altcoin market, the capital rotation is fascinating. The major altcoins like Solana and XRP are mostly moving with the broader market. But on the other side, some smaller cap tokens like PYTH and Neon have had insane gains in the last 24 hours, with some jumping over 100%. This really highlights the high-risk, high-reward nature of this space. These wild swings are a direct reflection of speculative retail sentiment. So you see, the market is really walking on two separate paths right now, one driven by stable institutional money, and the other by fast-moving retail sentiment. The interplay between these two forces is what makes this market so complex, but also full of opportunities. Alright, let's dive into the hottest topic of the day. Alright, let's talk about the hottest topic of the day. Have you noticed the insane amount of discussion on X about the partnership between Trump Media, Technology Group, and Crypto.com? The news itself is fascinating. A major crypto exchange collaborating with a company linked to a former US president. The potential energy and the influence behind that, to me, are pretty significant. But did you think that's all people were talking about? When I first saw it, I had a feeling there was more to the story. I dug a little deeper and found out the real reason for the heated debate in the community is actually a linked on-chain vote. This vote passed a proposal to reissue a staggering 70 billion CRO tokens that had been previously burned. That's not a small number, 70 billion. A lot of people's first reaction was, you can do that? I saw so many people on X directly criticizing the move, saying this is a textbook example of centralization in action, not decentralization. The community feels the transparency and fairness of the process were compromised. What's even crazier is that someone uncovered that the proposal passed because a few large validators essentially pushed it through on their own. It feels like the average person in the community has no say, and all the major decisions are controlled by a handful of whales. This kind of move is really challenging our understanding of what Web3's decentralized spirit is supposed to be. My personal take on this is that it's not just about 70 billion tokens. It's an unavoidable question for the Web3 world. When centralized power clashes with decentralized ideals, who truly gets to decide? It's a powerful reminder that while we're chasing hype, we need to do our due diligence and understand a project's governance structure, so we don't get fooled by the decentralized label. Alright, moving on from that controversial topic, let's get into some of the headlines that are really worth paying attention to. The first piece of news is, in my opinion, a continuation of our market overview. I saw that in just the past week, Ethereum spot ETFs have attracted over 1.3 billion in massive capital inflows. That number, honestly, is pretty wild. What does it signal? To me, it shows that institutions on Wall Street are now truly viewing Ethereum as a standalone investment asset, not just Bitcoin's little brother. This kind of money isn't just pushing up Ethereum's price, it's fundamentally shifting where capital is flowing in the entire crypto market. We used to always say that when institutions come in, they look at Bitcoin first because it's digital gold. But now, Ethereum is proving through its actions that its value proposition as programmable money is being accepted by more and more mainstream capital. For Ethereum's long-term development and its price, this is an incredibly powerful tailwind. The second piece of news, I think, is particularly interesting. It connects the craziest part of the crypto world with the most buttoned-up part of traditional finance. I saw that an institution called Canary Capital actually filed an application with the SEC to launch a spot ETF for the Trump-themed meme coin, Trump. When I first saw that, I have to be honest, I was a little stunned. This isn't just any ordinary ETF, it's a combination of a crypto speculative hotspot, the US political landscape, and a Wall Street financial instrument. To me, that's a very strong signal. It suggests at least two things. First, meme coins are no longer just a joke. They're breaking into the mainstream financial world in a way we never would have expected. Second, with the election getting closer, the intersection of politics and crypto is only going to get tighter. Capital always has the best nose for these things. So, I feel this ETF application itself is even more important than the price swings of the Trump coin. It might be opening up a completely new door for the future of the crypto market. Now, this next piece of news is, I think, a really crucial one. It's about the future of decentralized finance. I saw that a coalition of major DeFi players recently sent a letter to the US Senate. The core demand of this letter is simple, but it has huge implications. They want Congress to clarify that software developers, like them, should not be classified as financial intermediaries by regulators. When I saw this news, my first thought was, this shows the entire industry is starting to take a proactive stance. They're not just waiting for regulators to come down on them. They're getting ahead of the curve and explaining to lawmakers that DeFi developers are like engineers who write code. They're just creating tools, not operating a financial institution. They are making the argument that you can't blame the person who manufactured a knife for a crime committed with it. I think that logic is pretty sound. This letter signals that the DeFi industry is moving from its Wild West phase to a more mature one, actively participating in global policy making to secure a fairer regulatory environment. For our final news story, I want to give everyone a heads up, because it once again proves the old saying, when trading crypto, safety comes first. I saw a really heartbreaking piece of news. The YZY token launched by Kanye West completely collapsed in just a few days. What's even sadder is that the data shows over 51,000 traders lost nearly 74 million in this fiasco. When I saw those numbers, I felt genuinely sick. This was a game between the whales and retail investors, but it was rigged from the start. I saw some on-chain data analysis showing that in the middle of this collapse, only a handful of large holders, the whales, were able to perfectly time their buys and sells to exit with massive profits. The regular people who rushed in because of celebrity hype or just pure FOMO were left with almost nothing. This news is a powerful reminder that, in the world of crypto, any project without real technology or a solid use case, and is just driven by a famous name or social media trends, carries a much bigger risk than we think. It's a constant warning that you should never base your investment on anyone else's belief. Alright, that's it for today's Web3 Daily. If you found this helpful, please remember to hit the like button to show your support. We're here every day, sifting through the most critical and wealth-adjacent news in the Web3 world. Hoping that this curated information helps you make more rational and informed decisions on your investment journey. Also, I've already prepared exclusive registration links for all the major exchanges in the comments section. These are high rebate offers that we've secured specifically for our fans, and we hope they can help you save some money on your investment path. Let's all stay rational, move forward steadily, and get rich slowly in the world of Web3. May your crypto assets grow steadily. We'll see you tomorrow.